to today's Business Brunch. My name is Ria Shepherd. I'm the office manager based in Charles Stanley's Oxford branch. And today we're going to be talking about your finances in 30 minutes. Too many people think the world of finance is so complicated and technical that it's impossible for anyone who isn't a professional to understand it. But this simply isn't true. The basic principles of economics are easy because they primarily reflect common sense. To explain some of these basics, I'm joined today by Giles McKean, who's one of our senior investment managers based in Oxford, alongside Gary White, who is Charles Stanley's chief investment commentator. We'll be using as little industry jargon as possible and look at why each of these issues matter to you. So Giles, what does this all mean?
Morning, everyone. Thank you, Ria. What does this all mean indeed? Over the next 30 minutes, Gary and I are going to try to cover off the main points on inflation, interest rates, bonds, and equities, and how these have an impact on both your day-to-day and long-term finances. What this means in practical terms is if, say, your pension is earning 8% a year annual returns rather than 5%, then maybe you can retire at 60 rather than 70. And if you have a really firm grip and firm understanding of your finances, you might be able to work out that you only need to work 3 days a week rather than 5 days a week. So these things really matter a great deal and have a very profound impact on our lives and happiness. So to start with, inflation. Inflation refers to a general increase in the price of goods and services in the economy over time. It effectively decreases the value of money because you can buy fewer items with the same amount of cash. The opposite of this is deflation, where prices are falling. As we'll discuss later, this is generally a situation no government wants. Most Western countries aim for an average rise in inflation of about 2% a year. But why would a government or central bank want prices to go up in the first place? Making goods and services more expensive for everyone. Western governments want to see inflation at about 2% because it makes economic sense. A bit of inflation and the expectation that it will continue helps stimulate activity. It encourages people to spend, which helps boost the economy and create jobs. It may be easier to appreciate this by considering the opposite scenario, a deflationary environment when prices on average are falling. In isolation, falling prices could be good for an individual household, but for the country as a whole, everything getting cheaper is a bad thing. When there are falling prices, this often encourages people to delay purchases so they can grab a bargain in the future. It's the economic equivalent of waiting for the January sales. It especially discourages consumers from buying non-essential items such as flat screen TVs, cars, or washing machines, because they could save money by waiting for these items to fall in price. For example, my mother is installing solar panels on her roof. If she thought that the price of electricity was going to fall each year for the foreseeable future, she might not bother. As a result, her cash would just sit in the bank, being relatively unproductive. If lots of other people decide not to spend their cash, but put it in a bank account instead, it would cause a slowdown in activity with a consequent negative impact on growth, employment, and tax revenues. So for a country as a whole, a bit of inflation is a good thing, with the sweet spot at about 2%. But for an individual saver, it's a major problem. Price rises deplete the value of your cash because you can buy fewer things with it. As most working people understand, the below inflation pay rise is not really a pay rise at all. It is a pay cut, not a theoretical pay cut, a very real pay cut. Your salary will buy you less than it did last year. For those charged with managing an economy, this erosion of the value of cash savings over time is another factor that helps keep an economy growing by encouraging spending and investment. Cash is not designed to be a long-term store of value. It is designed to facilitate the exchange of goods and services. Cash sitting in your bank account isn't particularly productive or helpful to the economy. Doing almost anything else with it is more helpful to everyone else in the country. Repair your roof and you help create jobs. buy a coffee and you help create jobs. Invest in government bonds, company bonds or shares, and you once again help create jobs. Of course, official inflation figures are averages, measured across a relatively small number of products or services. Everybody spends their money differently, so each person will have their own personal inflation rate that differs from everybody else's. Anyone who has had a mortgage over the last 10 years and is lucky enough to still be employed has potentially experienced a very high level of deflation. A mortgage is usually our largest cost, and mortgage rates have been falling dramatically for the last 10 years, reducing mortgage holders' costs significantly. And in some cases, probably enough to completely outweigh the 2% annual increase in inflation, in official inflation. Additionally, those of us who usually commute, but are now working from home, may have saved hundreds of pounds a month over the last year. Even after the COVID crisis is resolved, many of us are likely to continue working from home for all or a portion of the week. In other words, if you're a mortgage holder and have switched to working from home this year, for you, no change in your salary may represent a very large real terms pay rise, as your own personal inflation rate may be something like -5% to -20%. So it's actually a deflation rate. If you find yourself in this position, you may like to consider spending some of the money you've saved on home improvements or ordering a few more meals off Deliveroo, moves that will help stimulate the economy and create jobs. Back to you, Ria.
Brilliant, thanks, Charles. So now we're going to look at the wider implications for an economy. Globalization has brought about a taming of inflation, but this has resulted in wages stagnating in the Western countries. So, Gary, what are the major causes of rising prices?
Thanks, Ria. So inflation is a measure of the rate of increase in the price of goods and services each year. If inflation is significant, leading to significantly high prices for necessities such as food, it can have a negative impact on society as the cost of living soars. So, what causes rising prices? The first is called cost push inflation by economists. This is when the rising cost of prices pushes up the total cost of producing something. A good example of this is the price of metals. If copper and aluminium prices go up because there is a shortage, it can cost significantly more to produce a car or a washing machine or anything really that involves wires or metal. The second reason for inflation is termed demand pull inflation. This type is where demand for a product is so strong, a company can keep increasing prices because customers just want the product. Obvious examples of this are seen in technology, where companies such as Apple can keep upping the price of products such as iPhones, but customers will still queue overnight to buy their latest gadget when it goes on sale. The demand for these is so strong, the market can withstand price increases. Rising wages are also a major contributor to inflation. They increase the cost for a company, which they usually recoup by increasing the prices of their products or their services. An increase in wages also boosts someone's disposable income, so they tend to spend more, increasing overall demand for goods and services in an economy, which is also inflationary. To keep economic growth steady, central banks use inflation as a target when they are deciding what to do about interest rates. In theory, if inflation is rising more than is desirable, boosting the cost of living, raising interest rates will increase borrowing costs, resulting in a fall in demand. That's because people's mortgages go up and the cost of companies' borrowing rises, so spending ultimately falls. They can also restrict the flow of money into an economy by, for example, requiring banks to hold more money as reserves against bad loans. These are monetary policies designed to lower inflation. Inflation is too low, then a cut in interest rates should have the opposite effect. So, Why hasn't central banks' response to the two major crises of the 21st century, the credit crunch and the COVID-19 pandemic, resulted in inflation? Both responses have involved keeping interest rates very low and printing vast amounts of new money. Official figures show that inflation is missing in action for most of the past decade, longer really, but that's because rising prices haven't happened in the areas that are included in government inflation figures. In the credit crunch, central banks channeled their newly created money into the financial system by buying bonds. A lot of this money stayed in the financial system and pushed up the price of assets such as bonds and shares. Government measures of inflation only track the basic cost of living, such as food and shoes. So it's been absent in these numbers, these official figures. To deal with the pandemic, the latest crisis, central banks are money printing once more, but this time the money is moving outside the financial system. In America, they've even been sending checks directly to people to spend as they see fit to help jumpstart the economy. The Biden administration also plans an almost $2 trillion stimulus program, boosting demand in many areas. This has recently caused some to worry that inflation may be about to reappear in official figures once more. Indeed, these concerns about inflation were the main cause of wobbles in the stock market in early 2021. If central banks are forced to increase interest rates too soon to deal with sharply rising prices, it could derail the recovery from the COVID-19 pandemic. These were the fears. However, central banks are not too worried about this issue. They see any price rises as temporary and a pledge to let inflation move ahead of their 2% target to allow any recovery to bed in before they raise interest rates. There are also enough issues in the global jobs market to ensure that people shortages will not push wages higher anytime soon. Thanks, Ria.
Great, thank you. So understanding interest rates is one of the keys to understanding the global economy. Before we look at what interest rates mean for the world generally, we're going to examine the impact of an individual's wealth. Giles.
Thank you very much, Ria. So, as Gary noted, interest rates are the main tool that central banks use to control inflation. The general idea is if inflation is below target, you cut interest rates to encourage spending, as saving isn't rewarded as much. And it becomes cheaper for households and companies to borrow and spend on goods and services, which increases demand and usually inflation. Those with existing borrowing, like mortgages for households or for companies' revolving credit facilities, have to pay lower rates of interest, which means that they have more money to spend on other things, creating demand, jobs, and higher inflation. If inflation is too high, a central bank may raise interest rates. The problem that we may face in coming years is if inflation gets consistently above 2%, then central banks will want to raise interest rates to reduce it. However, raising interest rates also impacts demand and therefore the economy's growth rate. If we have above 2% inflation and weak GDP growth, central banks may find themselves between a rock and a hard place. They may have to choose between above target inflation or depressing the economy and job creation. Understanding interest rates is incredibly important. It isn't necessarily immediate or proportional, but if central bank interest rates start heading up, then the interest rate on your savings and your borrowings will follow in due course. If you have more borrowings than savings, rising interest rates are bad for you, and vice versa. You should think very carefully about all the interest rates that you're receiving from saving or paying in mortgages, loans, car loans, or even home or car insurance, some of which incorporate an interest rate if you want to pay monthly. Ria.
Thanks, Charles. So now we've heard about the importance of interest rates to an individual, but what about the global economy? Gary, how do changes in interest rates impact the world?
Well, Ria, interest rates are important from a global perspective, because any change in a major economy can alter the flow of money all around the world. Interest rates have a significant impact on currency markets. So countries with higher interest rates can attract more savings and investment. At a basic level, raising interest rates goes hand in hand with appreciating currencies, as money is shifted from low interest rate countries to those where interest rates are on the rise. This can impact inflation as it changes the cost of imports and exports via the moves in currency. Obviously, the US dollar is the most significant currency to watch. The American economy is so dominant globally that any changes in interest rates over there impact us significantly over here as well. The US's economic fate is important to our own. The Federal Reserve has calculated that the foreign spillovers of higher EU interest rates are large, and are on average nearly as large in other countries, especially Western countries, as the effects in America itself. It showed that 1 percentage point increase in US interest rates hit economic activity in advanced countries such as the UK by almost as much as it did in the US, around 0.7%. A strong dollar could also be bad for developing countries. Higher interest rates could make it more expensive for overseas borrowers to service their debts, as much of it is denominated in US dollars. It can also lead to money being taken out of these emerging markets and transferred to the US. Brazil, Turkey, and South Africa are the most consistently vulnerable countries on this front. So it's vitally important for investors to have a view on US interest rates when making investment decisions, no matter where they live in the world. The Federal Reserve really is that powerful. Thanks, Ria.
So inflation really is the enemy of your savings then. Let's have a look about what you can do to ensure that your money works for you. Giles, instead of investing your cash, instead of keeping it at the bank, can help beat inflation, but isn't that a little bit risky?
Yes, there is certainly risk in investing, of course, Ria, but there's also risk in doing nothing too. So inflation is devaluing your money over the long term, and interest rates are below inflation. This means that your bank savings are losing value in real terms. What can you do about it? If it's money that you might need within the next few years, then you can't do much about it, I'm afraid, other than find the best savings rate you can. For money that you know you won't need anytime soon, you can start to look at investments. And the first step up the ladder of risk from cash is government bonds. Another name for UK government bonds is gilts. There are two types of bonds issued by governments: conventional bonds and index-linked bonds. With a conventional bond, you lend the British or a foreign government £100, and they agree to pay a rate of interest, say 2%. You will receive £2 a year, known as a coupon, and then in 10 years' time, they give you your original £100 back. With an index-linked bond, the return is linked to inflation, so it could be issued with an agreed interest rate of 0. And then in 10 years' time, if inflation has been 2% a year, and we ignore compounding for simplicity, then you receive £120. So in this scenario, if inflation is above 2% over 10 years, then you're better off with an index-linked bond. If inflation is below 2%, then you're better off with a conventional bond. These are the lowest risk type of investments. Unless the government in question defaults, then you get the return that you expected when you purchase the bond. This is probably a good time to define how risk is measured in investments. In financial markets, the risk of an investment is usually defined as its historic or expected volatility. This is probably the least imperfect way to define risk. However, let's think about this for a second. Cash has 0 volatility and is therefore the least risky investment. However, if you hold cash for 20 years, it is almost guaranteed to have lost you a lot of money in real terms, so after inflation. A 20-year index-linked government bond will have much higher volatility than cash because it trades on the market and people can buy and sell it. So it is technically riskier, even though it is guaranteed to protect your money in real terms over those 20 years. So if risk was defined as the probability that an investment loses you money in real terms over 20 years, then cash would probably be considered the most risky investment that there is. The next step up the risk ladder from government bonds is money that you lend to companies through the purchase of corporate bonds. Lending money to a company is usually considered riskier than lending to an entire country. So companies tend to have to pay a higher rate of interest than governments do. This is not always the case though, and some companies have been able to borrow money at 0% interest rates. Furthermore, some countries have a history of defaulting on their debt, so they must pay higher interest rates than many large companies in order to attract lenders. The riskier the company, the higher the rate of interest rate they will have to pay to attract investors to their bonds. Ria.
So bonds can be some of the least risky investments out there, but what determines the price of a bond other than the general aim to keep inflation at around 2%?
Thanks, Ria. The bond market often operates uneventfully in the background, but it is extremely important in determining the valuation of many other financial assets. Bonds affect the stock market by competing with equities for investors' money. Bonds are safer than shares, but they offer a lower return. As a result, when equities are rising in a bull market, bonds fall and vice versa. Equities do well when the economy is booming. When consumers are spending, companies achieve higher profits and investor confidence is high. The situation favors shares over bonds. When the economy slows and share prices decline, that's when investors tend to prefer the regular interest payments guaranteed by bonds. But what determines the yield of government bonds in the first place? The most important factor is interest rate policy. If a central bank keeps interest rates low and is expected to do so for the full life of a bond, then the yield of bond is also likely to be low. This is the situation that we've been in recently. But if interest rates rise, other investments can start to look more attractive. So investors may try to sell their bond, pushing the price lower and raising the yield for the new purchaser as a result. The US Federal Reserve, the most important central bank in the world, controls interest rates through what it calls its open market operations. When the Fed wants interest rates to fall, it buys US treasuries, US government bonds, which is the same as increasing demands for the bonds produced by that nation. This makes their value rise. As with all bonds, when the value rises, the yield falls. This impacts equity markets too. Lower interest rates put upward pressure on shares for two reasons. The first is that bond buyers receive a lower interest rate and it forces them to consider buying higher risk stocks to get a better return on their money. This boosts demands for equities, which tends to increase their price. Secondly, lower interest rates make borrowing less expensive. Cheap money helps companies to invest and expand. It helps home buyers to afford larger houses. As a result, low interest rates boost growth. So a rally in the stock market tends to raise yields as bond prices fall as they're sold off. However, if the inflationary pressures begin to look up, investors tend to move back into the bond market and dump equities. The most important factor in bond markets is therefore inflation expectation.
Brilliant. So now we're going to take a step up the risk ladder and look at equities, which are shares bought via companies. Giles, can you shed some light on this for us?
Indeed, Ria. So the top step of the investment risk ladder for people wishing to grow their wealth is equities or shares. A share is exactly that. It is a share in the ownership of a company. Whether you own 20% of a business or 0.002% of a business, It is basically the same. You are the part owner of that company, and the board of directors appoint managers to run its operations in yours and every other shareholder's best interests, striking a balance between current and future profits. The beauty of owning shares is that you have asymmetric potential return outcomes. If you buy £1,000 worth of shares in a company, the company could go bust and you lose £1,000. Or the company could do well and your £1,000 is now worth £3,000, £4,000, etc. This is why diversification is an investment manager's favorite word. With a well-spread portfolio, you accept that you will own some companies that lose 100% of their value. But on the other side, you will own companies that rise by far more than 100%, more than making up for the losses and giving your overall portfolio an excellent long-term return. We have data on stock markets going back around 120 years, and this provides some interesting insights and demonstrates how time is what makes you great returns in stock markets. Firstly, the average return from shares is around 5% per annum above inflation, but with plenty of long periods below and above this level. If we say that inflation is 2%, then a 5% real return would mean a nominal return of 7%, and that you double your money in nominal terms roughly every 10 years. So over 10 years, £100,000 becomes £200,000. And over 30 years, £100,000 has historically become around £800,000 in nominal terms. If you have a time horizon of 5 years, around 75% of the time, shares have historically outperformed cash savings. That sounds pretty good, but that also means that in 25% of rolling 5-year periods, you would have been better off not bothering with investments at all and keeping your money in cash savings. You must be prepared to accept that occasionally you'll be very annoyed with your investment portfolio in order to potentially get good long-term returns. Over 10 years, shares have outperformed around 90% of the time. And once you get to 18 years, it becomes 99% of the time. So you can see that as your time horizon gets longer, your degree of certainty that shares are a good idea increases. Ria.
Brilliant, thanks for that, really insightful there. So Gary, we've heard all about inflation, interest rates and equities. Have you got any final thoughts for our viewers today?
Yes, just as a summary, really. So interest rates respond to inflation expectation, which impacts bond pricing and therefore the attractiveness of equity markets for investors. These are the main moving parts of the engine of financial returns. The key takeaways from this are that inflation means the value of money will fall with the same amount of money purchasing fewer goods than before. Inflation will hurt those who keep cash savings and workers with fixed wages. Interest rates are fixed by central banks and are determined by inflation expectations, as controlling inflation is the central bank's most important mandate. Rising interest rates increases the cost of borrowing for companies. It too raises the interest on loans such as mortgages, which impacts the spending of individuals. Most bonds pay a fixed interest rate that becomes more attractive if interest rates fall, driving up demand and the price of the bond in the secondary market. Conversely, if interest rates rise, investors will no longer prefer the lower fixed interest rate paid by a bond, resulting in a decline in its price. Equities are the riskier asset class because you risk losing all of your capital. However, they demonstrate superior returns and the ability to beat inflation over the longer term. The best way to deal with risk involved in equity markets is through diversification, through a well-designed and well-monitored portfolio that comprises both equities and bonds. Thanks, Ria.
Great. Well, thank you both very much. Really useful discussion today. Thanks everyone for watching as well. If you do have any questions or you'd like to get in touch to find out a little bit more about what we do or how we can help you, please do not hesitate to get in touch with us. Many thanks.